Hit it.
It's October 2nd, 2020, episode 99. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome to the show Ronald Stöferle from Incrementum Management. We discuss gold, inflation, and the intricacies of Austrian soccer. Then Harris joins us for Cuppy's Corner, where he tells us about his new largest position.
In This Week in Trading History, we go back to the 2008 Tarp bailout for the WTF clip of the week. Tesla bulls go super trooper. And we then get to our new segments of No Stupid Questions and Skin in the Game. And Kevin, we might even drink some beers along the way. So stick around, everyone. We got a great show. Lena, hop on. What beer are we drinking this week?
This week's beer is Left Field Brewing Company's Ephes Oatmeal Brown Ale.
Ooh, oatmeal brown. Yeah. It's like breakfast beer.
Yeah, I'm full just by looking at it. So it says here, our oatmeal brown ale is inspired by the seldom thrown Ephes, a risky and unexpected high-arcing pitch that catches the batter off guard. This American brown ale finds its sweet spot with aromas of roasted malts, toasted nuts, a touch of bitterness, and a surprisingly creamy, smooth taste.
A touch of bitterness?
This would go great with a pulled pork sandwich.
Oh my God. This is okay. I gotta stop. I gotta keep quiet.
All right. All right. Give us our disclaimer, Kev.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Johnson & Johnson, the airline queasies, and the house bound by the Democrats.
All right.
A little scatological humor today.
Okay. Let's get to our first interview.
It's with great pleasure that I get to welcome somebody that I've been looking forward to meeting for some time now, Ronald Stöferle from Incrementum Management, Money Management. Welcome, Ron.
Hi. Thank you very much for having me, gentlemen.
It's been just a pleasure. I've been reading your book, which I call the Holy Bible of the Gold Market.
That's politically not correct. It's not only the Bible.
It's a great read. It's huge. It's like 100 pages every year.
No, it's 350 pages.
Oh yeah, geez, I'm selling you short.
We tried to write less. This year the compact version was 100 pages, and most people say we need a compact version of the compact version. But there's just quite a lot of stuff to write these days.
It's a terrific read, and for those who are interested, make sure you sign up for our newsletter because you will be getting a link, or we'll list it in the show notes on the bottom of the YouTube page. Anyways, let's get to it. But before we do, I'd love to learn a little bit more about yourself, Ronnie.
Sure.
You know, you're from another part of the world, something that us North Americans aren't exposed to very often. You grew up in Vienna, and
Vienna, yes.
Even though you were in Vienna, it didn't stop you from trading stocks like any other North American young child. Like you started young, right?
Yeah, well, I bought my first stocks when I was like 13. And I did really well, which was a blessing or perhaps also a curse. And I remember the dot-com boom, and I even better remember the dot-com bust. I remember a company called adultshop.com. It was basically Australian Shell, a mining company where they put in an online sex shop. And when they IPO'd, the stock was up 600%. And, you know, it was just normal back then.
What did your folks think about you buying an online sex shop?
Well, actually, the funny thing is, basically the whole class, they kind of found out that I'm making tons of money on the stock market. So basically, 50% of my schoolmates they owned this adultshop.com, and afterwards travelshop.com. That was the beginning of the end. But it was crazy times, and I didn't have any clue about global macro, how interest rates, of course, affect stock market prices. And I learned that during the dot-com bust. But I think it was a very valuable time for me, and I hope that I learned quite a lot from it.
Right. So from there, you go in off to university and you studied finance. Where did you go to university?
Yeah, I studied finance and economics over here in Vienna. I always worked part-time next to my studies, so I worked for basically a financial newspaper over here, and afterwards I worked part-time at a trading desk in a big bank trading credit derivatives. I did a semester abroad in the States, University of Illinois, which was quite a fun time, and then I started working at Erste Group in Vienna, which is a really big savings bank. It's around for 130 years now, and I started analyzing Asian equities.
Okay.
But I was also invested in privately in a junior mining company called Osisko Mining or Osisko Exploration back then.
It's a good Canadian name.
Yeah, and that was a 40 bagger. And so I went to my boss and said, can I write about gold? I got this fantastic investment. I don't have any clue about gold. And he said, yeah, go ahead. So I started basically reading everything about gold. I started understanding our monetary system because nobody really teaches you, how our monetary system works, how money is created, and then from then on, 2007, every year I wrote a In Gold We Trust report, and now it is the most widely followed publication about gold. It's published in German, English, and in Mandarin. And we had roughly 2 million readers for the last edition, so it's really a big thing nowadays. Yeah.
I would have thought, being Austrian, that this is something that they imprint in you in like grade school. No, you don't learn about gold and hard money in grade school.
Not really.
No?
But I think it's interesting because I tend to say that we've got gold in our monetary DNA because of our history. If you talk to the generation of my grandparents, for them gold is just a monetary insurance because they lost everything twice or even three times. So over here in Austria, but also in Germany, I think we are still heavily influenced by the hyperinflation and the currency reforms. And I think that to some degree that also has an influence on central bank policy, because over here, I think, or it used to be like that, the ECB was more concerned about inflation because of this kind of Germanic influence, while I think the Federal Reserve has always been more concerned with deflation because of the Great Depression. So, but that, of course, I mean, now everything is is different and everybody's an inflationist. But it is, I think, gold over here, having physical gold, that is something pretty normal. You get it for Christmas, you get it for birthdays. It is something that you can, for example, if you go to a normal branch of a bank, you can buy gold coins. I think that's pretty uncommon in North America.
For sure. So you brought a great package here. Why don't we dive in here? And I love the first quote that you quote Karol Sokoloff, and he says that all roads lead to gold. And let's jump in here, and you show the first chart is this central bank flows year over year. What are you trying to show here?
Well, I mean, it's. I mean, you guys, you know it best, and I think it's what we're living through here is really unprecedented. Although the word unprecedented is almost used hyperinflationary, but you can see. First of all, a very strong correlation between central bank flows, but you can also see that the rate of change for central bank balance sheet growth for the ECB, the Bank of Japan, and the Federal Reserve is really staggering. And we saw it, I think, over the last couple of weeks when Jay Powell basically signaled, okay, well, that's it for now, folks. until the meeting after the election. We won't do anything, and the market didn't like that too much. So I think, you know, we're so heavily addicted to even more and more. It is frightening, and I think this year has been, for every one of us, I think, as a citizen, as businessmen, and also as investors and researchers, it has been extremely fascinating.
I completely
I learned
agree.
a lot.
Yeah.
And I think, you know, when it comes to inflation expectations, so I think that's the major difference between 2008 and 2009 to spring of this year. If you compare inflation expectations, they recovered much more quickly this time than in 2008, 2009, and this suggests that now it is not only monetary policy but also fiscal policy. But this time around, I think central bankers acted much more quickly and much more aggressive. And on top of that, we have seen this enormous amount of fiscal policy stimulus. And this basically led to this great recovery in inflation assets. I mean, of course, in gold and silver in the mining space, but also in inflation expectations. They rebounded extremely quickly, and this just tells me that, you know, in this system that is so much over levered, where basically this over indebtedness is seen in every level, you know, for corporations, for sovereigns, for private individuals, we just cannot afford any deflation. And this was very telling from my point of view. And I think we will also talk about this paradigm shift that might happen from disinflation to inflation. And I think, you know, when it comes to basically this fork in the road, I think we have seen that in spring of this year. So we're heavily geared to a more inflationary future.
So let's talk about that fork in the road, because I happen to agree with you, but I'd love to hear why you think we've hit the fork in the road. Like, why is this time different than 2008, which also had lots of quantitative easing, lots of worries about inflation, yet it didn't materialize? Why is 2020 different?
Well, I think first of all, when it comes to the definition of inflation, Austrians, and by that I don't mean Austrian citizens, but followers of the Austrian School of Economics, which is, by the way, not really taught over here. I think we're extremely Keynesian over here, and it's fascinating that in countries, in former socialist countries, for example in Eastern Europe, they really know their Hayek and their Mises, because they just know how socialism feels and they don't want to have it again. But I think, you know, if you come up with the Austrian definition, you would say, okay, there has already been an enormous amount of inflation, meaning monetary inflation. But we've also seen the second stage, which is asset price inflation. So, you know, just have a look at real estate markets all over the globe. Have a look at equity markets, of course, the art market. You know, collectibles going crazy. I just, somebody said that the cardigan that Kurt Cobain wore at the MTV Unplugged was sold for a ridiculous amount. I think 600,000 or something like that. So you're seeing this asset and price inflation in all sorts of areas, and most importantly, of course, in the bond market. But so far, we haven't seen any price inflation, and this is exactly what central bankers want to achieve. And I think few believed that the Fed could tame inflation in 1979, and few believe that the Fed or central banks in general can spur inflation in 2020. That's what our mutual friend Luke Groman said, and I totally agree. Paul Volcker's job was to kill inflation. Now central bankers all over the globe want more and more inflation. They're very vocal about it. And And this is something that the gold community doesn't really like when I tell them. Basically, you're sitting in the same boat like central bankers. It makes them feel a bit uneasy. But when it comes to this change that we're seeing, first of all, I think it is the combination of very, very aggressive central bank policy and fiscal policy. That's
Right.
one thing. The second thing is, I think this trend to deglobalization is definitely an inflationary driver. I think that in general, this kind of Cold War period that we seem to be entering might also be inflationary going forward. And I think that the irony that we're seeing at the moment is that the greater the deflationary concerns that policymakers must fight today, the greater the debt buildup and the higher the inflationary risks are in the future. So I think if central bankers would do nothing, of course the laissez-faire approach would be highly deflationary. Our monetary system wants to deflate, but in our monetary system, we just cannot afford any deflation. So we have to counteract with inflationary policies. So we described that with tectonic plates pushing against each other. And I think at the end, inflation will kind of win. And probably the most important driver is really the fact that at the moment it seems, and I owe quite a lot of respect to Russell Napier, who did a tremendous job in pointing the world to that fact. I think that governments really want to take over credit creation. We've seen that with all those state guarantees, and politicians seem to think, okay, that works pretty well. So let's guarantee an infrastructure deal, a new Green Deal, education, whatever. And this, it also ties or goes into the direction of the MMT camp. And Kevin, you've been writing about MMT quite extensively, and I totally agree. I think it's from a philosophical point of view, perhaps we don't like the ideas of MMT, but I think nobody really cares about our opinions, because this is the direction where the world is heading to. MMT-like policies, I think, especially if Joe Biden wins, but we're seeing also moves into that direction in the Eurozone. I think this is really what's going to happen. And therefore, I think, it means, of course, less free markets, less capitalism, more interventionism, more inflation. That's the path that we have taken. And I think that when it comes to political science, but especially when it comes to central bank policy, path dependency is something crucial that one has to understand. When an institution sticks to a path for so long, it finds its options very limited to detour and to exit this path, and they will go on this path. So I think, going forward, I think 2020 might really be the year when we switch from a highly disinflationary or deflationary environment to an inflationary one. And just have a look at the price of gold, have a look at commodity prices, have a look at commodity currencies. They're already showing us that inflation is being discounted.
Ronnie, that's great stuff. And one of the things that I liked best about your analysis was the comparison of 1979 being the end of inflation and the kind of the era of disinflation. And if we go back to that period, that was a great time to buy bonds. Real yields were very high, and over the next kind of 40 years, you rode that bond bull market. Yet now we're sitting in a situation where bond yields are minuscule and inflation looks like it's picking up. Do you foresee a disaster in the bond market going forward?
Well, a disaster. I mean, I would say, during the 1970s precious metals bull market, 10-year real yields got as low as minus 4.9%. And now, basically, the Federal Reserve said, okay, we'll have zero nominal rates until, what was it, 2023, something like
Right.
that,
3 years.
and probably longer.
Yeah.
And I think it has also been really crucial, and many of my colleagues didn't really get that. I think the average inflation targeting is really a big shift when it comes to Fed policy. So basically, they are telling you, okay, nominal rates will stay at zero. I don't think that the Federal Reserve will go negative, because it just doesn't work over here in Europe, for example. But then they tell you, okay, inflation was undershooting over the last couple of years, and 2% is not the ceiling. We want to see 2% on average. So for the next couple of years, inflation has to overshoot. So this is basically the recipe for negative real yields for the next years to come. And we wrote 3,000 pages of research about gold, and I think really one of the most important drivers, if not the most important driver for gold, is, first of all, the absolute level of real yields, but more importantly, the direction of real yields. So will we see falling real yields or rising real yields? And I think, and that makes me really relaxed when it comes to gold, because let's face it, we just cannot afford real yields at plus 4 or 5%. It's would be game over. So therefore, I think the foundation of this bull market in gold is very, very solid. And we've got one important chart in our chart book. It's on page 49, and it shows you the really long-term gold price as well as the real Fed funds rate. And you can see the 1970s, you had primarily negative real rates, which was a positive environment for gold. Then in the 1980s and 1990s, you had primarily positive real rates. So, which was a big opportunity cost for gold owners, of course. And since the year 2002, 2003, we have got mostly negative real yields again. And I think really, if you boil it down to a few factors, I think real yields are probably the most important driver for the price of gold. And you can see it also on page 50, this extremely tight correlation between gold and 5-year tips since 2012. And I think this is going to continue. So from a fundamental point of view, I expect a pretty good environment going forward for the price of gold. When it comes to bonds, we've got like 13 trillion US dollars in negative yielding bonds. I think if inflation should become a concern, and that's kind of my base case, then I think you don't want to be in negative yielding bonds. So I think if there is an exodus happening, where will this money flow to? And I think 13 trillion is quite a lot of money. Will it go into the stock market? Yeah, why not? Although we crunch the numbers, and per definition, equities aren't the best inflation hedge. It really depends on the sector that you're in. So from 1966 until 82, on a real basis, stocks were a horrible investment. And I can recommend the basically a paper by Warren Buffett, how inflation swindles the equity investor. It's really a great piece.
What's the title? I'm sorry to interrupt. I've never knew that he had written this paper. Do you know the title of it? Is it called
How inflation swindles the equity investor, I think.
Oh, terrific. Well, I'm going to go make sure. I don't know that one, so I'm going to make sure I read it.
Yeah, it's great, and by the way, I think talking Warren Buffett, he I wouldn't call him a gold bug, and now of course he started buying a Barrick Gold, and I think right. People mix it up, because he wasn't buying gold, he was buying a mining stock, and he saw a tremendous amount of value on the balance sheet of Barrick. I think there are better mining stocks, but anyway. But it is not only the fact that Berkshire is buying a mining stock now. He was also selling lots of financial holdings. I think the whole position in JP Morgan, Goldman, and also Wells Fargo. So perhaps he's also making the inflation trade now. And I think what's even more important was the news that Ohio Pension Fund said they will allocate 5% of their holdings in gold. And I really see this as the big trend from what we're seeing, talking to clients or potential clients. It seems that there's a completely new set of investors coming into the gold market. Those are really institutional players with deep pockets that haven't had any allocation in the gold or in the mining space, and now they are really entering the market. And I think that really this has to probably to do with the inflation outlook.
Right. So, Ronnie, a few things. Let's start with, just for those who don't know what real rates are, could you just briefly explain real rates to people? Because I know that someone listening might say, but rates were really high in the 70s. How were real rates negative? Why don't you explain how that could be?
Well, it's basically the nominal interest rates, or of course you can also take 5-year bonds or 10-year treasuries minus the inflation rate. Right. So that gives you real rates.
Right. So for those who are wondering how in the 70s rates were negative, is because inflation was running higher than inflation. But sorry, interest rates were below the rate of inflation. So therefore, in real terms, you were losing. Yeah. And now it's this, we can use TIPS yields as well in the current environment, because there's an actual product to use to determine the real rate. The second thing I wanted to chat about was, you mentioned this briefly, the average inflation targeting, the change that Powell did. And I have a real smart subscriber to my letter that said to me, we're going to look back at this period and realize that this was a huge monumental shift in the way that the Fed behaved, and the market is not appreciating it enough. What would be your comments to him? Would you agree with that analysis, that the market isn't appreciating how important that shift is?
It is. I think that, nowadays, I read somewhere that the average investment advisor is 54 years old. So in his professional career, he never really experienced any inflationary or even stagflationary market environment. So I think also that the fact that basically over the last couple of years, it was like the boy who cried wolf. Many people, especially also in the Austrian camp, they said, okay, in 2008, central bank balance sheets, they're going bananas. It's hyperinflation is around the corner. But of course, people tend to forget that most of the money is not created via the central banks, but in the via commercial credit. So I think that many people are just getting bored of this, inflation is around the corner argument. But I think this time around, it might really happen, and I think that nobody is really positioned for inflation. That's it is very much of a contrarian position that you can have, and I think we are managing a fund that is investing in inflation sensitive assets. So our investment universe is basically mining stocks, gold and silver especially, but also commodity stocks. It is commodities in general, but also commodity currencies like the Russian ruble, like the Canadian dollar, like the Australian dollar. And we manage our fund based on our incrementum inflation signal, which basically tells us, government statistics like CPI and PCE, they basically tell you what inflation was a couple of months ago. So it looks into the,
the past.
Into the past, yeah.
Right.
But we want to see what the market is discounting. So we only use market-based factors, and our inflation signal is the strongest since we basically calculate it, and therefore we're having the highest position in inflation-sensitive assets at the moment. So I agree to your reader. I think this shift in Fed policy in summer was definitely underreported. Everybody was probably lying on the beach and having a good time, trying to forget about a Corona. But this is a big shift, and I always quote. I think I'm really reading lots of stuff, and that's what I truly enjoy about my job. And I think Lords of Finance was a terrific book that I have reread several times. And he says monetary policy does not work like a scalpel, but more like a sledgehammer. And and I think it's always really, I mean, that's going more into a kind of philosophical or political discussion. But I think it's really important to tell people that the monetary policy that we're having and that we had over the last couple of years create a huge distribution and created is to a large degree responsible for all the inequalities that we're having. I mean, I have talked about asset price inflation, and basically, I think it's really important, and this is also why we try to inform or kind of educate our readers about our monetary system, because it is something that is not taught at all, and I think we should not forget that this is really a systemic crisis that we are in. And I think that with normal central bank policy and the measures that were used back in the days, we are seeing declining marginal utility. So we need more and more and even more aggressive measures to see even a smart impact on markets. So I think this is really important. And now I think coming back to the inflation topic, I'm really pretty sure that this is it. I think this is the year when finally inflation is becoming a real topic again. Nobody is positioned for it, and as I've said, markets are telling us inflation is being discounted.
Right. So, Ron, one of the things that you mentioned is the fact that in 1966 to 82, stocks in real terms did poorly, but you said that there were certain sectors that would outperform and do well in this environment. Obviously, gold stocks were some of them, but what were some of the other surprising ones that people might not be aware of that do better in an inflationary environment?
Well, in general, it's companies with pricing power. I think that's really the most important thing that you want to see in your portfolio. Then, of course, it also is important what kind of debt structure and how the companies are financed. And in general, I think you should lean more to a kind of hard asset allocation. Of course, mining stocks did tremendously well in this stagflationary period, but also commodities in general, the energy space, obviously, and companies, I would say high quality companies that had superior products where they could charge, where they basically could hand on the price increases that they saw to their clients. That's really it. So I think if inflation becomes a concern, you have to become much more selective in your sector rotation.
Right. Now, the other thing that you talked about and mentioned was the fact that we are getting an expansion of the investor base, meaning that there's more pension funds and what I call long-term serious money looking at gold as an investment. I was wondering, have you actually experienced this with more people reaching out to you? Whereas, when you were writing your book a few years ago, you were sitting there in Liechtenstein and a little bit lonely, and now all of a sudden you're the celebrity and getting calls from all sorts of pension plans, and you're becoming a little bit kind of famous. Have you experienced that?
Well, when I started writing about gold in 2007, I think interest rates were at 5% in the US. Fed balance sheet was like, I think, 700 billion. It was it was really a different time, and over the years, of course, then it's at some point when gold is rising, the media calls you and you do some interviews and stuff. But also in 2013, I was walking on the streets, and there were some guys passing by, and I said, "Isn't that gold guy from Incrementum? Well, he doesn't look good. Probably correlates with the price of gold." and now just recently, gold bull market being back, and I think in spring when gold was really hot, my ex-girlfriend, she called me, and I haven't heard from her in I think 13 years, and she called me, "Hi, so how are you?" I said, "Yeah, I'm well, I'm married, I've got 3 kids now." Okay, well, I want to buy some gold. And I said, "Okay, thanks for calling." Read Mine Gold We Trust. So this is, sentiment wise, it is definitely, I think we saw over the last couple of months that sentiment really got extremely positive, and I follow, Commitment of Traders report and Sentiment Trader and so on. But from a top down technical view, and I did the CMT program and the CFTE, and I think it's, technical analysis really, it adds lots of valuable tools to your toolbox and to your approach. And for me, the Dow theory, and especially those 3 phases of a trend, were extremely valuable. And Charles Dow said, first, there's the accumulation phase, where only, die-hard contrarians buy into something against the media, against public opinion. That's, when you mention at a cocktail party that you're buying into this investment, everybody's going to ridicule you. Then the second stage is the public participation phase, which is the longest phase. And I think we're in the middle of this public participation phase. This is the moment when, the media picks up on the topic again, when everybody is getting a bit more positive, when at the cocktail party you say, "Yeah, well, I like gold." Some people will say, "Yeah, gold is a good idea. Perhaps I should have a closer look." Perhaps, do you have some mining stocks that you like? So I think we're like kind of in the middle of this public participation phase. And of course, the third stage is the distribution phase, where everybody is going crazy, where JP Morgan comes out with a price target of 5,000, where everybody is buying junior mining stocks, and where if you go to the cocktail party, everybody is gonna tell you some financings in junior mining stocks in Burkina Faso or in Mali. So I think we're still far away from that, but I can tell you that interest is definitely picking up. It is a new set of investors that is coming in. I just attended the virtual Beaver Creek conference, and then the Denver Gold Show. I had like 70 meetings with mining companies, and at some point I felt, okay, am I at a value conference now? Because those mining executives, they were really, they were talking about their balance sheets. They were talking how to increase shareholder value, raising dividends. They were talking about record free cash flow. Really, really good stuff that I haven't heard in the last bull market. Now, probably they will screw it up in this bull market again at some point. But it is my job to basically make a good selection and pick the ones that deliver shareholder value. But it is really, I think, within the mining sector, I think we're seeing the highest leverage on rising gold prices ever. And therefore, I think that the mining space still is pretty attractive. Also here we saw some financings over summer, some kind of shady promoters coming out. They were in the I don't know, cannabis space, and they were in the blockchain space, and now they're doing mining again. But in general, I think that the industry is quite healthy at the moment.
So Ronnie, it's Patrick here, and I want to circle back with you a little bit onto this inflation thing, because for over 2 years, me and Kevin have been like at each other over and over again. Kevin always like inflation is coming, and I was like, yeah, but you're way too early. And I really, you're here saying this is it. This inflation is coming, but I want to kind of put some context into time frame, because at the same time as like I look at one of the great input variables into inflation as being energy prices and oil, which continues to be pressing at very low levels. And you look at the demand numbers coming out on oil, still very weak. This coronavirus and the economic havoc it's causing around the world continues to be a deflationary drag. And no matter how much money they're throwing at it right now, it's just keeping things in check from becoming a deflationary spiral. At some point, I completely agree with Kevin and yourself that inflation will be the end result. I do agree with that in principle, but I continue to be more in that camp that it's still a little early. Like this thing could still drag 6 months, a year of just economic turmoil that still will prevent that manifestation of that inflation, and that it could be more of a late 2021-22 story before we really see those scary numbers versus now. What do you think of that opinion I'm just giving you? Like, where would you push back on me on that?
Well, I think when it comes to energy prices, of course they're pretty important for the whole equation. And now we're like in the biggest economic crisis since probably the Great Depression. And I would ask you, why is Brent then trading at $40 and WTI at 37? I would suppose it should be much lower, but on the other hand, I think there is an enormous amount of deflationary factors at the moment. Definitely, you see it in rents, you see it in of course of the in the labor market. So I totally agree. There's lots of deflationary factors, but I think at the moment we are kind of at a point in time when those inflationary factors they're kind of getting more and more stronger and stronger. And as I've said again before, the longer we have these deflationary pressures coming in, I think the more aggressive central bankers will have to become, and fiscal policy will become. And we completely lost any sense for those numbers. Deficit is going to be 3 trillion, 4 trillion, whatever. I mean, who really can follow those numbers? Nobody has got any clue about the size of and the enormous amounts of money that are and will be created. But I think most people underestimate the time lag, and I once said, that's the tequila theory of money that I once established. I said, I don't do tequila shots anymore. I used to do it when I was studying, but the first one doesn't taste really good. But then 2, 3, 4, well, doing well, and then it's party on, and then at some point you wake up next day, and the sister of your best friend is lying next to you, and I think this time effect or this time lag when the effect really kicks in. This is completely underestimated by central bankers and politicians. So all the money that is created now and that will be created over the next couple of months, I think, and this is a theory that I had, and I don't know if it's a bad theory or if it makes sense, but I think the major problem that we're having now is this enormous amount of uncertainty. Nobody really knows when it's gonna get better. And you've got the winter now coming up over here. It seems that we are at the beginning of the second wave of the whole COVID crisis. They are kind of considering a second lockdown. I want to go to a conference in Munich next week, and I just don't know if I should do it or if I'll be able or allowed to do it. And this whole uncertainty that is in the market and that is affecting our behavior, I think this might be resolved once a vaccine or a really good treatment will be introduced. I think this will really be the point in time when confidence is coming back and people will see the light at the end of the tunnel and everything will get a bit more positive. People will start perhaps considering booking a vacation again or going to a conference in a couple of months later. So I think this vaccine could really be important, really start this paradigm shift. So basically, this should be the point when velocity, or the Austrians would call it, demand to hold money, would kind of reverse. And this might also be the point in time when actually central bankers would have to become more hawkish, and they would have to say, okay, perhaps we've done enough, we'll have to reduce liquidity. Politicians would have to say, okay, let's reduce our stimulus. But I am absolutely certain that they won't do it because they underestimate this time lag. And then I think this is basically the perfect recipe for inflation in 2021 or perhaps even later. Our mutual friend Dave Rosenberg, he said, talking about inflation or stagflation now is like when you're served only the appetizer and you're already thinking about the dessert. But I think it's a good comparison, and I often think what shall I choose? Will there still be place for the mousse au chocolat or the tiramisu if I have this appetizer and this main course? So I think it just makes sense positioning yourself for inflation, especially as inflation assets are still pretty cheap. I mean, I don't know anybody outside of my bubble that is really bullish commodities. If you have a look at copper prices, if you have a look at agricultural commodities, I think those are really nice charts. So perhaps I'm a bit too early, but I think there's not too much downside actually.
So, Ronnie, that's a great thing, and I just like mic drop, and you should walk away from Patrick in terms of his deflationary. The world's
because I've been wrong for 2 years,
implosion.
right?
Yeah, well, it just took a worldwide pandemic for you to get right. But anyways, one of the things you mentioned, Ronnie, is
so you're responsible for it.
Yeah,
right.
Japanese. Yeah. So one of the things you mentioned was the fact that you said that the Bitcoin and cannabis promoters have now turned into mining promoters again. And I just wanted to let you know that as a Canadian, that's all is well with the world again, because those guys were originally mining promoters. They moved to the cannabis, then they moved to the Bitcoin, and now they're back to the mining. But you mentioned that you were at the Denver Virtual Gold Show. Do you have any names that you will be willing to share with us of companies that you like, that interest you and you think might be something to keep on our radars?
Well, actually, I'm not 100% sure if I'm allowed legally, but I don't think that the Liechtenstein Financial Market Authority is listening to your fabulous podcast.
Definitely not.
No, I think in general, as I've said, just to give you a few fundamentals. First of all, the top 15 North American gold producers have a market cap so small that Apple at the moment is 9 times larger and Facebook is almost 4 times larger. We're seeing, price to cash flow being at the lowest level in 30 years. We're seeing price EBITDA at a very low valuation. We're seeing that actually, weak local currencies versus the US dollar is one of the factors that we saw over the last couple of quarters, being a big driver. We're seeing energy costs, an important contributor, still being reasonably low. And I think Wood Mackenzie came out with a fantastic study, and they said the gold industry must spend 37 billion over the next 4 years just to keep production flat. So the industry will need to commission 8 million ounces of projects by 2025 to avoid a perpetual decline in gold supply. Now, that doesn't mean that I'm in the peak gold camp, which is completely nonsense, because those people don't understand the stock to flow ratio. It doesn't make any difference if we produce 3,300 tons or 3,000 tons, because the actual stock of gold is so big, and we're not only trading with the gold that is newly produced. So I don't think it has an impact on the price of gold, but it has a dramatic consequence for the M&A activity. So I really like, first of all, I like the silver space a lot. We did lots of research on the gold silver ratio, and if our assumption is right that we're in a gold bull market, then silver should continue to outperform gold. So the silver mining space is very, very small. So when investment flows into silver mining equities, it's like the Niagara Falls running through a garden hose. So that will have an impact. Then I like, in the large cap space, there really good management out there. For example, with Agnico Gold, I'm always very much impressed. I think that Mark Bristow is doing a good job at Barrick. I think in general, for the large caps, if you want to keep it kind of conservative, there's good names out there. On the smaller side, I like, for example, great exploration companies like Amex. I like on the development side, I like Mineral Alamos. I like O3 Mining, which is a great company. I like Skeena. I think that Corvus is a great takeover story. I think in the silver space, Alexco looks great. For the larger caps, I forgot Kirkland Lake. Still lots of upside from my point of view. And yeah, so there are great names out there. I think the sector is still heavily under-researched. I think there's, and this is something that we really want to change, because let's face it, everybody wants or everybody has an opinion on gold.
Yeah.
I've never met any investor who doesn't have an opinion on gold. If it's built on a solid thought process, that's a different story. But I think that the problem that the gold industry has is that there's lots of rubbish research out there that is mostly gloom and doom. Everything will go to hell. We will see hyperinflation, currency reforms, and civil wars. You should buy gold.
Right.
And for me, I think, gold is, it's just like a good defender in your portfolio. And you probably don't follow Austrian soccer, right?
No, but actually, it's on my list. I was just about to ask you about it because honestly, we had passed some emails back and forth, things we might talk about, and you mentioned Austrian soccer, and I thought, boy, everyone was sure biting at the bit to learn about Austrian soccer.
Yeah,
so tell us about it.
I think your viewership is going through the roof now. No, I said I'm a supporter of Rapid Wien, and being a football or a soccer supporter from Austria, that's a bit masochistic. But there was this defender called Robert Petzl, and they also called him the Rote Robert, so the Red Robert, because he often got a red card,
Right.
or Iron Leg, that was also his nickname, because he was really, his technical skills were not really great, but he was just a very, very solid and hard defender. And I think that gold did a tremendous job this year, just balancing your portfolio. I think it really did its job, and we wrote about gold and said, okay, if you want to hedge against a recession, gold is a good idea. If you want to hedge against rising inflation or falling real rates, gold is a good idea. And if you want to hedge against a weak dollar, gold also does its job pretty well. And therefore, I think, I don't like this comparison. Is gold better than equities? I think it doesn't make any sense. It's like if you compare the Austrian soccer team to the Canadian hockey team. Yeah, it's nonsense. Yeah. But I think you need a solid defender in your portfolio. We still know that 0.5% of all investments at the moment are in gold and gold-related equities. So basically, nobody is really invested. So I think, that makes me pretty optimistic going forward. And I sometimes think, perhaps it's a bit too easy. And I think, where is the flaw in my thought process? But then I think, just have a look at the chart, and it's just gold is rising in every currency. Mining stocks are outperforming gold. Silver is now outperforming gold. So it's really a stealth bull market. And therefore, I think what should you do in a bull market? You should buy the dips. And this is what we're doing.
Well, that's some great advice. And one of the things you mentioned is how it's a great defender. And it made me think back to the fact that you're from Liechtenstein, you're not from there, you're from Austria, but you work in Liechtenstein. And I've actually been there. It's I know it's a strange place to have visited, but my best friend actually worked for a big company there. And one of the facts that I love best about that country is the fact that they actually had -1 fatalities during a war. Do you know this story?
No.
Oh, so in 1866, the Liechtenstein army had an army of 80 men and fought in the Austro-Prussian, how do I say that? Prussian War. Yeah. Okay, so they suffered no injuries or deaths. And then the good part about it was they returned home with 81 people because they made a new Italian friend who decided to join their army.
I didn't know that one.
Yep. So the 80 men went to war, 81 came back. That's my kind of war. Now, you have to tell me a little bit about your country that you work in, because it's one of those kind of countries that a lot of people are curious about because it's such a small little place. And what's it like?
Well, it's I always ask people who ask me about Liechtenstein, I ask them, have you ever been to Las Vegas? I say, yes. Okay, Liechtenstein is the complete opposite. So it is. It is a
no fun.
It is a no. It is a very conservative place, and it is. I love the fact that our company is there. It's extremely solid. It is one of the few countries. I think there are 5 countries on Earth without any government debt. So actually, they are running a surplus every year. The Liechtenstein family, they're heavily influenced by the Austrian School of Economics, so they treat their clients, as they say, really well, and they want to deliver good services to them at reasonable prices. So there's a great book by Hans Adam Liechtenstein. It's called "Government in the Government of the Future." I don't know the name of the English translation, but it is a fantastic book, and it's fairly small, 35,000 people. That's the whole country. It is very flat hierarchies. If you deal with government officials, it's very casual. They want to solve problems together with you. The banking system is extremely solid. It is not in the European Union. They have got the Swiss franc, which is also probably one of the more solid currencies over here. So I think it is a fantastic place to be located with the business, especially when it comes to the financial services industry. They're very, very open to the whole blockchain technology, to cryptocurrencies. So there's quite a lot of stuff going on, and I really appreciate the fact that we're based there.
So I'm reading that once a year, all the residents are invited to a party in the castle.
Yes.
So have you gone? Is it a good party? Is it spike the punch bowl with tequila kind of party?
It's a bit different, yeah. But there's free beer. It's good times, yeah. But it's I wouldn't compare it to, I don't know, spring break in
Illinois.
Yep. No, we went to Panama City Beach. Florida.
Okay.
That was
there
special.
You go. Well, I'll leave you with one last interesting fact about Liechtenstein. They are the world's largest leading manufacturer of false teeth.
Yes.
Oh, yeah, they make 20% of all teeth, false teeth. They make 60 million sets of teeth every year. That's crazy.
That's probably a good market to be in.
As people get older, you're absolutely correct.
Yeah. No, it's a very, very innovative country. I think the number of how do you say patents per capita is extremely high. So there's lots of market leaders in small niches, like Hilti, for example, which is a company that is successful all over the globe. And many people don't believe how many famous companies are coming out of this very, very small country. But it tells you a lot if the government doesn't interfere and just lets it people and entrepreneurs work. There's lots of creativity and entrepreneurial spirit that can be used to be successful.
There we go. I knew we'd get some Austrian economics from you, and we'll leave it with that. So listen, Ronnie, it's been a pleasure having you on. I've enjoyed this tremendously. I look forward to doing this again someday. In the meantime, why don't you tell people where they can find you, where they can see you on Twitter, and where they can find your terrific, I'm going to call it the Bible of the gold market. I don't mind. It's that good.
Thank you. Well, I'm quite active on Twitter. My handle is @Ron_Stöferle. Our webpage is incrementum.li, which stands for Liechtenstein. So there you can find out more about our investment services. We're running investment funds and wealth management and special mandates, especially in the real asset space and commodities and precious metals. And then our webpage that is dedicated to our In Gold We Trust report, where you can find this year's In Gold We Trust report and the previous 13 editions, as well as the chart book. Everything in German, English, and also in Mandarin. The webpage is ingoldwetrust.report.
Terrific. Well, thanks again, Ronnie.
Thanks, Ronnie.
Thank you very much. It was great fun. Thank you, gentlemen.
Okay, Patrick, it's time for Talking Charts. What do you got for us?
Well, we had a long show. We're just going to cover some of the key charts that we want just to see what's going on. That S&P 500's been bouncing since last week, but so far not an impressive run up for the bulls. I mean, it's pretty much been one big up day, and then it's really been sideways price action since. It really does feel like it's toppy, even though the news of Trump getting the vid has started some selling, but it never really followed through. What's your take on that?
Well, I think that the fact that Pelosi indicated that they were so close to doing a fiscal stimulus really put a bid to the market. But then, at the end of the day, the tech stocks looked awfully weak. It's difficult. One of the things, Patrick, I was noticing is the fact that this morning, going into the unemployment number, which is usually what we would be focusing on in this environment, it was a complete nothing burger. It almost felt like it was Christmas, the Christmas Eve, and there was nobody at the turrets, and there was nobody trading. And I'm a little worried about it. It's a little spooky. It is. When I see things not moving, and I don't really understand why.
It's interesting though because even though, like you were saying, even though the S&P was down 20 points, Nasdaq was down 320 points today, with a pretty distinct bearish engulfing candle coming down on the downside, and a lot of red on the fangs. I mean, Tesla was down 7%, but you had Apple down 3%, Facebook down 2.5%, Microsoft down 3%, Amazon down 3%. So while the S&P seemed to be just hovering, Nasdaq was eating it pretty hard, right?
Yeah, it looks like, which is also unusual because you think with the news that the U.S. administration is coming down with the Rona that you would see those kind of stay-at-home stocks get bid, and in fact, it was just the opposite.
Yeah, it was. And so what I wanted to do is come back here and then let's talk some of these commodities, because another 4% down day on crude.
Oh, it's ugly. Crude is rude these days.
Yeah, I mean this got hit pretty hard. And what's interesting is that we're down to that low from early September. And the big question is there another leg lower? Now, the fib zones that I've been watching are all the way down into the low 30s, which but I've still been in the conviction that this is a one big buy on dip. But I mean, could this whole oil demand thing be dragged out and oil goes for a full double bottom retest? Like, this is, by the way, the November contract. So, I mean, a retest of those April lows is not minus 40, but rather down into the mid 20s. But do you think that there's a chance that we go for? There's always a chance.
I'm not the Dumb and Dumber guy. There's always a chance, but I think that's likely? No, I don't think that's likely. I look at it, and I think this has a lot to do with the fact that the Chinese were away on their golden holiday. It started with, I don't know if you were going to talk about it, but the copper just was terrible.
But look at the recovery today.
Yeah, well,
you were watching.
I was watching because I'm long, way too much copper. But I was kind of joking and saying that copper is like that crazy girlfriend you lived with in university. Like, really, honestly, it's like she's a lot of fun, but you're not sure you want to settle down because it's a little bit all over the place. I'm going to chalk it up just to the fact that the Chinese weren't there for the bids.
I think that's a soft excuse, but we'll give it to you for now. I personally think that it's all the dollar is going to play such a big role, and the dollar hasn't shown its hand. So I still think there's more for this to play out. But I wanted to just just have a quick chat about this yield curve, the 5s, 30s, because I know you've been toying around with it. Are you still long this?
Yeah, I try not to look at it. It's just a core position. Honestly, you think I'm kidding? It's a core position. I don't look at it. I actually didn't even know where it was.
You just don't have a big size of it, or do you have?
Well, I have enough on that it doesn't matter. I kind of see it moving around, but I'm not watching every tick. No, because I want to wake up a year from now and just be long this thing. So I put it on in a size that I can live with the intraday swings, and I don't worry about it. I'm not going to trade it. Is basically why I don't look at it.
Yeah, no, but generally, this has been from a technical perspective. It looks really good. I mean, obviously, this is just really a play on how bearish the 30-year yield gets, right? Because you're in the bear steepener camp, right?
Yeah, well, it's tough for the 5-year to go
much lower,
much better.
Right?
Yeah,
I mean, it's 28 basis points, right? Yeah,
you expecting it to go to 0 or negative? I guess it could happen.
It could, but that's not where the big contributor to this really. You're just looking for that big blowout. You know what? It's interesting. I would not be expecting this to be steepening at this stage, and so therefore the fact that it's interesting to me, and that's why I wanted to bring it up in today's session.
I'm kind of proud of you, Patrick. You're bringing up charts that don't agree with your thesis. I like it.
Well, you have to stress test some of the ideas, even though I'll be right in the end. No, just kidding. Anyway, so listen, let's leave it at that for talking charts. We'll do a longer session next week. Let's move on.
Okay, folks, it's time for that. Oh, sorry, I'll start again. Okay, folks, it's Cuppy Corner time. It's a fan favorite. He's back. Harris Kupperman in the house. How are things?
Doing well. How are you guys?
Good, man. Good.
Great.
It's a little bit of exciting day today.
Yeah, it was super exciting. Trump's got COVID. Oh, don't sound like so excited.
What I was actually thinking the other day that we in Canada, we've had three leaders with it. We had the leader of the opposition, our Tory, our conservative guy had it. Our Bloc Québécois had it, and then the Prime Minister's wife had it. And I thought, you guys must just be better with your leaders at making sure they don't get it. And then as soon as I thought that, the news hit.
Yeah, I think Trump was saving it for later. Right before the voting. I think it's the best thing that's ever happened to him.
Why?
Indulge us. Why is this?
Guys, you can't be an asshole to a president when he's recovering from COVID. I mean, look at the New York Times. They even toned it down. They're like level 4 angst instead of 8. No, seriously, even Nancy Pelosi wished him well. Come on.
He's playing he's playing chess while we're all playing checkers.
As a good friend of mine, I was thinking he's playing like, third level, thought process here. And he gave himself COVID this week because, you know how it is. They're going to have an update every 15 minutes. Trump's feeling a little better. We're hoping for Trump. We're praying for Trump. Trump had some chicken soup today. It makes him human again.
There we go. It's all part of
really
the master
does.
plan.
It's
okay.
Brilliant. I reached out to a good friend of mine, and I'm saying, this must have all been premeditated. I don't even know if he has it. And my friend said, no, Trump just kind of like falls forward successfully. Every time he screws up and trips on something, he falls forward and wins. He just did it again.
Well, there you go. Before we get to piss off all of our listeners somehow by saying something offensive politically, let's just move on. So you had a great day today, Cuppy. You had the Tortoise acquisition, the SHLL, which got a new symbol. Your arbitrage trade came in line, right?
Yeah, I put this thing on at $14 credit, and I did it through some short calls, so it was really 21 credit to me. And as soon as they changed the ticker symbol, it came in. Now it's trading 9 wide, which, it's basically 50% of the spread came in one day. And, it's looking good.
That's right. You make it sound like it's the change in the ticker symbol that did it.
Well, I think people realize that Hyliion, I don't even know how to pronounce this thing. It just sounds like a fraud.
Well, I actually think it's because the warrants became registered and they became the ability to exercise them, right?
Did they register them?
Well, I think so, I think that's what's happened. I think it has to do with the registration of the warrants, and that's why the spreads come in.
I don't see any registration statement yet. It hasn't hit the tape. No, I think it's just a function of the Robinhooders kind of giving up on this thing. In the end, this is the second one of these we played. Kevin and I played Nicola, and the Robinhooders can buy the SPAC, but they can't buy the warrant, so the spread blows out. And this is about as riskless as you can get in finance to put something on and just sit there and wait for it to compress. And it compresses on the registration, which is about 30 days from today. I'm happy it's compressing sooner. Gun to my head, I want nothing in terms of exposure going into this election, and I'd love to take it off when the spread collapses to only a few dollars wide. So I'm happy it's making tracks.
Right. For those who don't know, I was so proud of Cuppy when he started to understand and explain the fact that the borrow rate affects the forward on the option pricing. I thought, God, this guy's turning into a real option trader.
I learned from a master.
You're going to be up there giving us lectures about gamma and theta and vega risk before you know.
No.
but it was a great trade. It was something that everyone should look at, and make sure you go and follow Cuppy's blog because you chronicled the whole thing. And it's one of these arbitrages that, yes, it's independent of the rest of the market. So while we're all looking for such, kind of uncorrelated assets, these sorts of trades are terrific.
And they just keep popping up. I don't know why, but ever since the world ended in March, these sort of event-driven trades have just been more lucrative than anything else. I really do think that there were some big event-driven funds that blew their brains out, and there's just not a lot of capital right now searching for these sort of things. And the spreads are wider than they used to be, and the opportunity is better than it's ever been. Of course, this will eventually converge and there'll be a bunch of people looking at event-driven. But right now, I just keep spending more and more of my time on event-driven. I wrote about another one of these, which is the Dillard's short squeeze. It's the great Dillard's corner of 2020 or whatever. It's like the Northern Pacific or whatever. That was like the last great corner. It's the same sort of situation though. You have a company like, I don't think I actually want to own this thing long term, but there's 6 million shares short and there's like 5.5 million shares in the float. And if you take out the ETFs, there's like 4 million shares in the float. And Dillard's just keeps going in there and chomping away.
That's the
They have a
symbol
buyback
DDS,
still.
right? That's
Correct,
the DDS.
correct.
So it's this. Okay. All right.
So the Dillard's, the company, they're just using the revolver and they're buying back shares. I mean, they bought back 260,000 in August. I assume they kept chomping away at it in September because starting a few days ago, the borrow rate went from like 15, 20% and it spiked all the way up to 130%. So clearly someone's scrambling around there. And then it stayed there at about 130 for about 2-3 days and the stock started to boogie too. And I don't know where this is going to end. I just think it's going to end higher. For those playing along at home, just remember, short squeezes end and then they collapse. So make sure you sell a little on the way up.
All right. I was telling you that it trades a little like a rat on acid. It's all over the map. It's a tough one to trade, and it goes in these violent waves. And this is what happens when you get people getting bought in, right? It doesn't trade normal.
I mean, if you look on the screen, you'll see it'll just sit there and be trading very little volume. Then it'll have a $2 bar on like 50 or 100,000 shares. And, mind you, this is the sort of company that only traded like 200,000 shares a day, but there'll be a 50, 100,000 share just market order as someone who doesn't have borrow just goes lifts it. But then, whoever's selling it to them, it just screws up someone else's borrow and this thing kind of cascades through. In the end, it's musical chairs. And like I said, there's about 4 million, total shares in the float and there's 6 million short. And the company keeps buying it in. I don't know how this thing ends, but because I don't think there's a precedent for this outside of that northern corner where, I mean, for students of history, two robber barons wanted to control this railroad and they fought each other because they each had 49% of the shares and they were literally willing to pay any price for that last share. And some guys got short and they couldn't buy it in. They couldn't cover and the stock basically went to infinity. And these robber barons were, well, I mean, if you just need one more share to get your proxy, like you can pay an infinity for that last one share. I mean, if you don't, especially back then, the other guy was going to loot your railroad and you have nothing. So it was just this crazy thing. And I don't know if this could be as crazy, but it might.
So Kapi, I have a problem when you send me this stuff and you start talking about this event-driven trade, but you always talk about it and you give me the initials. And you talk about ED, and I keep thinking, my own personal problems is my own personal problems. Why you keep talking about ED with me?
I don't know what else to call it.
You got to come up with a new name. ED just is a terrible name. It is. You got to come up. We got to come up with something else, or at the very least, stop calling it ED because it conjures up the worst connotations. So listen, who do you think
look at the Dillard's chart? Look at the Dillard's chart. It looks like it just popped 3 Viagra.
So who do you think blew up? Like, talk to me about, like, speculate. Like, what do you think happened? You mentioned
I have no idea.
But do you really think that there's less competition in this square?
Oh, absolutely. Because, I mean, if you looked a year ago, this stuff would all be so arbed out. Like, Hyliion, there's not even a borrow cost. It's like 22% right now. Like, there's no way that this thing would exist given how liquid it is. It traded 7 million shares today. This thing would be like $2 off intrinsic. It wouldn't have ever blown out to 14, and it wouldn't still be sitting there 9 to intrinsic. Whoever was doing this in the past and arbing these sort of things out, they're out of the game.
Right.
That's interesting. That's great. Well, listen, really, people should have a look at this because these are some great ideas that you've been talking about. And yes, they're a little bit of complicated and you have to short some stuff, but a lot of times it's truly an arbitrage and it's offering some great returns. Now, let's get on to what we really want to talk about. You've mentioned it before on this show, but we're getting a little sneak peek on your new position that you've been very enamored with. Why don't you tell us what it is and why you think it's headed a lot higher?
Yeah, well, I've had that crush on this one stock for a while, and I kind of watched it for a year, and this summer I finally said it's time, and I guess it's Joe time. The stock is it's Joe time. No, the stock is St. Joe. The ticker is JOE. It's my largest position by far. I think there's a lot of ways to think about this company, but it hits pretty much every macro trend I'm fixated on right now. Everything from people moving from cities to suburbs, people moving to the state of Florida for tax purposes, land as a hard asset against inflation. Just all the different trends that they all converge with St. Joe. And, when I think of it, I think of this as kind of my gold proxy in many ways. And it's actually better than gold because while you have land which should, track inflation, I'm coming into this thing about 20 cents of the dollar. It closed today about $21. And, I think the NAV is north of 100. And, you can make the case that it's, a good chunk north of 100, depending where you peg the assets. So you're coming into gold at, a big discount to the fair value of gold. And, gold just kind of sits there in your sock drawer and doesn't do much of anything. And this thing's actually earning some money. I think they'll earn about $1.50 next year. I think in 2023 they'll be kissing up on $2, maybe even a little over $2, depending on how it's going. But you're basically buying into a company that's growing 30 to 50% a year every year, probably for the next multiple years, probably 5-10 years into the future, just as people migrate to the Florida Panhandle where they have their 175,000 acres. So you're going to get 30 to 50% growth. You're coming in at 10 times earnings, and they're giving you 100 and change per share of land for free. And I've now made 2 trips to the Panhandle this summer. One, I just love it up there, and I think it's the prettiest part of Florida. It's the best beach in the United States. It's kind of like the Hamptons of the South. I remember being a kid, we'd go out to the Hamptons in Long Island, and back then it was mostly just potato farms. And, if you could have bought the Hamptons knowing what it would become, you'd have made a fortune. And I think this is the same thing. This is the Hamptons for Houston and New Orleans and, Mobile and, Atlanta and all the other cities around there. And when you drive around there, you meet, it's the one percenters from all those places. And, if you're going to have a global equity asset bubble, the one percenters are going to do very well. And they're definitely going to want to go to their Hamptons. So in any case, I've been following this for a long time, but never really got the traction needed. But it's hit critical mass now. This year was the busiest that they've had. You speak with all the locals; they've just been overwhelmed. There's 3-4 hour waits at restaurants, and just getting an Airbnb for the week is painful. Just because so many people want to move there, is not enough inventory. And in the end, it's not enough inventory because the 2 main counties, Bay and Walton County, St. Joe owns all the land, and they get to choose, how it gets developed, when it gets developed, and they're going to develop it as fast as their capital lets them, but. Like I said, I don't think you have all these compounder bros chasing SaaS stocks that aren't really growing very fast, and they're paying 30 times sales or something. And here you can come into something that's growing faster than most of those SaaS stocks, 30 to 50% a year, and you're going to come into it at 10 times earnings. So anyway, that's kind of my pitch to you. I guess the catalyst that I think unlocks this is that this 7 million shares of this thing short. I don't know what these people are smoking. But they've been short for a while, and I think it's just one of those lazy shorts where they put it on 10 years ago and they kind of forgot about it. And the short pitch has always been, they have some really good acres. No one disagrees with me, but most of their acres are crap. They're worth 1,000 or 2,000 an acre. And anyway, Margaritaville, which is Jimmy Buffett thing, they're building a mixed use community. I don't really know why you'd want to live in a Margaritaville, but that's a different topic. But they're going to start putting them for sale in Q1. I think they sell out. All the inventory for 2021 gets sold almost immediately, probably the first or second day, like happened in Daytona in Florida. And when that happens, all these acres that all the shorts thinks are worth 1,000 or 2,000 an acre turn out to be worth 100,000 an acre. And I think that changes all the math on this because they have 175,000 of these acres. And if the worst acres are worth $100,000 and the best ones are worth a few million, it just changes the whole price deck. And suddenly the shorts start panicking because you really start capitalizing this land at north of 100 a share. So anyway, that's my pitch. It's my largest position. I've been buying it every damn day. Every down day I go in and just grab another 5,000-10,000 shares, and it's gotten to the point where my wife said I can't buy anymore. It's pretty much all I own.
Now, I have so many questions, especially from that last comment. First of all, who knew that there was Margaritaville? And I'm going to be on the other side of your trade. I think a Margaritaville sounds awesome.
All righty. We already have a new customer.
Okay. In all seriousness, why do you think Wall Street's missing it?
So this is the typical scenario in most of the stocks that I follow. There's no investor relations function at the company. If you want to learn about the company, it's amazingly difficult. They have a corporate presentation, but it doesn't really tell you much. There's no map of what they own. You have to beg management to get the map. I have the map. But most people in New York have never been to the Panhandle. They call it the Redneck Riviera, and they think it's full of trailer parks. And I was just there for 2 weeks, and I invited a bunch of my friends who had never been there, mostly Northerners. And they came out there and they go, wow, this is amazing. And I'm like, well, I told you it was amazing. They're like, I didn't believe you. I thought it would just be trailer parks. And I go, no, these are $10 million homes in this mile upon mile of them. And my friends are like, yeah, I get it now. And then so you're looking at it and you see these $5 and $10 million homes on one side of the street, and on the other side of the street, as far as the eye can see, is St. Joe land, and you realize that you could build more of those homes. And all my friends are just like, I got to buy more shares. Like you're right.
Wow. And so it's just a question of Wall Street not caring. There's no investment banking business to do. And it's just
There's no investment banking. The company's been shrinking the float. They buy back about 2% of the company each year. So, they're not out there telling the story. They want to get more shares. It's kind of, it's this thing where, a lot of people got burnt about 20 years ago during the last housing bubble, because at the time they, told you how great the land was, and it was great, but it just wasn't ready yet. The Panhandle wasn't growing. It's this chicken and egg funny thing. So if you have a bunch of land and you want to develop it, well, until you have people and residents, you can't build a grocery store or a Starbucks, and you can't sell home sites if you don't have a Starbucks and a grocery store. So it just took a lot of time to hit the critical mass needed. And now they've hit the critical mass. It's just got escape velocity and it's going parabolic. But I think a lot of people have just been sleepy on the name and forgotten about it. Everyone just goes, "Oh, it's a land play. Those take forever to work." And it's like, yeah, it's been 100 years. It's taken forever.
So one of the things is Berkowitz that was his big name, right? Because he went up against Einhorn on this way back when, and he still owns it.
He's chairman. He's the largest shareholder. Put it this way, okay? He had a very, very successful investment business. I admire the guy. He's, one of the greats in this industry, and he's pretty much made no money for the last decade. And that's because he just sat there with his Joe saying, I think it's worth $200 a share. And if you don't agree with me, redeem me. And as people redeemed him, he ran billions and billions, and now he runs like his PA, and he calls it a mutual fund. But as people redeemed him, he gave them back all the liquid stuff, and he kept the Joe because that was the best. And you ended up with a mutual fund that really just owns Joe because he knows what it's worth. And I feel like he's going to be vindicated. And you start looking at it, and you look at it through the course of his career, he'll once again be one of the greats because I think Joe's a multi-bagger. I think you have this sort of thing where, let's say, you peg the land at 100 a share, just made up number. Okay. And let's say just through inflation and through population growth and everything else, the land appreciates 5% a year, another made up number. Well, you might say, well, 5% a year, that's not that exciting in the equity world. Like, who's going to pay you 2 and 20 on that? But then you realize that 5 a year is on your 21 purchase price. And you're starting to look at, 25% a year, add in the $2 of cash flow. Now you're at 7 on 21, and you're making 30% a year. Like that it starts getting pretty attractive in terms of just a compounder. You can buy it and forget it. And, I think this one's going to be hard for people to analyze. I think a lot of people, once you post this, they're going to email me and be like, well, I built this spreadsheet and I'm plugging in this price per acre. I don't get to 100. And you just can't think of it that way. You can't take 175,000 acres multiplied by a per acre value. You really have to go there and understand it and see the assets and understand what's possible. And I think people are going to have a hard time putting a concrete number around it, which is why it trades at such a large discount. It's just hard to analyze.
Right.
I get it. It's okay. So we got the St. Joe. What else is on your mind these days, Cuppy?
Oh, the election. I'm just degrossing. Stuff comes across my plate and I'm just like, man, that's juicy. I want to take a swing at it. And then I'm just like, nope, election coming up, degross, don't buy anything. And I'll buy a few shares and be like, oh yeah, I'm supposed to be degross. I don't know what's going to happen election day. It looks like it's actually a lot closer of a election than, it was last time we talked about a month ago. And I just don't know what's going to happen. And I think it could be terrifying. On one hand, Trump can win and then it's basically 4 more years of the same. in which case, some stocks do well, some do poorly. And if the Democrats win, it could be anarchy. I mean, if it seems obvious that the capital gains rate is going to increase in 2021, I would think that anyone who has gains is going to have to book them, sometime in the 6 weeks after the election. And you might see a lot of stocks, collapse. And then, the other scenario is that no one wins on day one and we fight it out in the courts for the next 100 years. And I definitely don't want equity exposure then. So right. I'm just degrossing mode. No one knows what's going to happen. I feel like you're not missing much on the upside, and you can miss a lot on the downside, and it can be kind of crazy. I mean, the stuff I'm carrying through into the election is like my Ruger puts. I wrote a bunch of Ruger puts. I hope they assign me. My Smith and Wesson puts. I got my Joe. I got my tankers. I got some stuff like that, like my core book. But in the end, I got a bunch of October paper that goes out worthless in 2 weeks, and I'm just degrossing.
Well, there you go. That's the Oh, sorry, Patrick. Go ahead.
I was just going to ask you. You're mentioning the tankers. I mean, they continue to just bleed. Do you think there's is there a catalyst this year, or is this one of these things where you just got to wait it out like a St. Joe's?
I mean, on the tankers, I think the catalyst is when rates recover, and rates aren't going to recover until petroleum demand recovers. So you have these companies that retained huge amounts of capital, and they trade at 1/3, maybe at most half of net asset value. People look at the charts and they go, oh, rates went up, rates went down, and they peg the stocks to where they were before rates went up, and they forget that they retained so much capital. I don't know what unlocks that. It could be that, QQQ IWN unwind, where these things just are caught up in the vortex of IWN, catapulting, IWN being, small cap value. Yeah. Or it could be rates recovering, or maybe tankers just suck. I don't know. I mean, it's funny. Like my TK tankers, they locked in 1/3 of their vessels for the next year, so they're doing just fine, and they've been penalized all the same as the guys who are, making no money right now. And then you have like my Dorian, which is the other tanker I'm long, and very large gas carriers are actually earning record rates right now. Like people don't realize how much money they're making, and that one's hit just the same. I don't know. I guess it's.
Well, everyone's degrossing, and then no one wants to put the money to work. Yeah, like I've never used it before. It's a cuppy word for me.
It's a cuppy word. So one last thing.
They're all degrossing. I mean, there's a lot of shorts they need to cover.
Yeah. So true. The last thing, we'll let you go after this, but I want to know what you think about nat gas, and I think it might be a sleeper hit. And if you still love the Sandridge.
Yeah, I love nat gas. I think it's going to work out just well. We're sitting here with oil at 37. No one's incentivized to drill, especially in the U.S. Production in the U.S. is going to trail off, which is great for my tankers. But if that production is trailing off, same happens when it comes to byproduct nat gas. And I don't know when nat gas is going to catch a bid, but it will. And it's going to be very good for the guys with a lot of gas exposure. My biggest gas position is Sandridge. They have effectively no debt. I think they'll earn somewhere between $1 and $2 a share based on where you peg nat gas next year. And it just seems silly that it trades at 1x cash flow. And of course, if they're not drilling, it's in slow motion decline, and it's probably going to decline in the 20s. But you just build up a PDP deck of this thing and call nat gas $3, and I mean you have a double-digit share price. And if oil recovers, you have a much better share price. And I don't know. I think this thing is a home run, but I mean I'm also like a terminal bag holder, so.
There was something about the real estate was worth $1 a share or something anyways, wasn't it?
Yeah, they sold their headquarters. They didn't get what I expected. They sold their headquarters for $35 million. I thought they'd get about 60, which is disappointed. But they paid off all their debt. But yeah, I mean, when it comes to energy, I seem to be an expert in how to lose money. So maybe you should just do the opposite of me.
Well, the reality is that everyone's gotten crushed, right? Like, how bad are the energy stocks? They continue to trade like death. And
yeah,
I guess
it's crazy. Like some of these guys like Antero, they just rolled all their debt, okay? So the short thesis was they have a 21, 22 maturity wall, and they'll never be able to refi it. Well, they just rolled all the debt forward, and the stock's down anyway.
Yeah. Nobody cares. Like the reality is that you're sitting there. How do you justify going and owning extra energy? Like, you have to be sadistic to like stick that on your sheets and to get everyone mad at you and stuff. Like it's just not worth it. It continues to have to trade to dumb levels for, you know, people that are just like, this is a no-brainer buy. That's when it's going to be time to buy it.
I think that happened 2 years ago.
Well, I think though you're assuming that there's actual real bids out there. Like I think it's going to be like the Philip Morris. Nobody wanted it on the sheet. Like it was only the people that were able to take the kind of social pariah that was involved with owning the stock and sticking it on your sheets. That's the price it went to. They have become the cigarettes, the cancer stocks of our generation. Don't you think?
Yeah, absolutely. But I mean, if you really want to go down that rabbit hole, why not just go for thermal coal? I mean, why bother with nat gas? That's clean. Just go straight for the thermal coal.
Yeah, but listen, that though has a good chance of government legislating it out of existence, does it not?
No, a quarter of the United States electricity comes from thermal coal. They legislate it out of existence, and you and I are going to sit in the dark. I mean, you're not going to charge up your Tesla without electricity. It'll be a process, and it'll be another 25-year process to, you know, in terms of running these electricity plants into the ground and replacing them. And you know, my thermal coal company should make a lot of money before now and then.
So, what are some of your thermal coal companies for those that are willing to take the political heat?
So I own some ARLP, Alliance Resource. It's really cheap, and the insiders own a lot of stock. And you know, I used to pay a really fat dividend, but they canceled that to just delever a little. But I mean, it's like $2.75. It was like $15 2 years ago. I mean, you split the difference, and it's a pretty good run. I wrote some Peabody puts when they didn't get their deal done with Arch, and I assume I'm going to get assigned on those, so I'm back in Peabody. What's the other one? HNRG. I don't know. I have a basket of these things. None of them's too big, with the exception of Alliance. But,
the charts just look like death. I was pulling up these charts as you were saying them. I was like, does Cuppy own anything that doesn't look like it's been cut in like by 90%?
No, that's usually what I look like. But then, you know, that's how it is. But then, you know, eventually they start looking like Dillards, and you know, I start feeling smart. And
yeah,
it's just a process.
It's a process. What I love best is when we're chatting and some stock all of a sudden gets a huge bid and it doubles, and you're like, oh, I own a ton of that. And I'm like, when do you own this from? Like I would love to see your inventory sheets, because there must be so many just illiquid, crazy little value plays that nobody's ever heard of.
Yeah, I got about. I mean, I'm a core book, so I run a very concentrated fund. We're 6 to 12 positions. We tend to be like the top 5 names would be about 90%, and then I have my little, you know, positions. I just kind of like little piker positions, you know, 50 bips, 100 bips, just to keep track of stuff. And you know, I tend to pull a lot of alpha out of those little positions. And you know, the funny thing about small cap is that you got to buy it when it's hated, and you got to sit there and inventory it, like you said. And 3 months later, 9 months later, is that press release that unlocks it, and it goes on a moonshot, and you know, you got that like 48-hour window to unwind it, and then it just starts like going back into its death spiral.
That's funny.
That's funny. You know, in Canada, we have a lot of these deals with the unit deals where they give you half a warrant. And for a long time in the 2000s, when the China situation was, you know, China was expanding and all these mining stocks were going crazy, all the hedge funds would buy these private placements, short the stock, and then be left with the warrants. And I remember one of my buddies went and worked for another hedge fund. He moved in. He says, Kev, I got there and I couldn't believe how many lines of crappy warrants they had. He says it was literally like, it was like each day it was, you know, half an inch thick of all these lines. It was madness. And that's kind of what I figure. That's how I kind of figure your book looks like.
No. I have probably about 15 positions that are like little piker ones. No, I did that warrant stuff too. I did a lot of these commodity plays, like during the great gold bull run of 2003 to 8. I mean, any pipe that someone did, we were just like, yeah, we'll be in for 100,000 units, you know, whatever. Yeah. And you know, we weren't shorting, and we'd actually own them for the 4 months, and then we'd sell it the first day we could, and we just keep the warrants. And you know, I ended up getting like millions and millions of warrants in every single mining company in every country. Guess how many of them actually came into the money?
Not that many.
0. we never exercised a warrant.
Come on, really?
Totally serious. Never once.
That's funny.
That's
We made some money on the common, but we never once exercised a warrant. Sometimes they went in the money and we held on too long. We never once exercised a warrant.
because you know what, you're a dreamer at heart. And for those who don't know, Cuppy's always going for the upside. He's always a believer that it's upside. And you're always like, when we're chatting and I'll say, oh, I'm short the market. He goes, I'm short too. And you'll talk about it and you'll be short for like 10 minutes. And then you'll be like, I can't take it anymore.
But
I get short.
Kev, you got to understand though. That's how Cuppy gets his 10 baggers. Like you have to be willing to dream a little bit and give a chance for the thing. Because you're up 10 points and you're like, I'm out. Like you can't ever have a 10 bagger because you're too quick on the trigger.
Yeah, no, you're absolutely right. You're absolutely right, Patrick. There's no doubt about it. I'm going to try to be more like Cuppy. That's going to be my.
Which means hold a whole bunch
the words,
of
watch them go deep in the money, and then eventually expire worthless. Okay, listen, man. We're gonna let you go, Cuppy. Thanks so much for coming on the show. Why don't you tell people where they can find more and for them to watch for the St. Joe write-up that you're gonna be coming out next week?
Oh, you just gave me a homework project?
Yeah, I thought you told me you were gonna do it.
Yeah, I'm gonna do it, but I didn't know if it was gonna be next week or not. Now I have homework.
Well, listen, for those who listen to the show, it might not ever come, and you're ahead of it by listening to us on the show, because Cuppy might be so lazy that he never bothers writing it up. He's just going to tell us by verbally. So where can they find you though? Because you should subscribe. It's a great read, and as I said, for those who are interested in ED trades, make sure you follow them. So where can they find you?
It's at Adventures in Capitalism, and you can sign up, and you'll get an email alert when I write something. And it's a free publication, so I only write when I feel like writing something. And
okay,
there you go, Cuppy. Just one last note: next week is our 100th episode, and it was a big milestone. And you're a part of this with your Cuppy's Corner, and we just wanted to thank you for having joined us on this ride.
Hey, appreciate it. I'm happy to be along for the ride.
Yeah, you're always a fan favorite, and people, whenever we miss it, we were actually thinking of having you on the 100th, and then we realized that too many people are going to be upset that they missed the Cuppy's Corner this week. Honest to goodness, we miss it, and I hear like, "Where's Cuppy's Corner? Where's Cuppy's Corner?" Like it's like so. I'm like, oh no, we got to keep him on his schedule because everyone's expecting him.
Hey, at least I'm not on vacation this week.
There you go.
That's true. Actually, this is a very rare episode where we're not calling Cuppy from a bar in the Florida South Canyon. Now people understand that it was not really vacation, was it? It was work.
It's all tax write-off.
Yeah, it was work. You were checking out St. Joe's, and that's why you were there.
All due diligence. Yep.
Yeah.
You know what? That's genius.
Yeah, it's Cuppy is kind of the equivalent of when you're young and you decide to take a year off from university and you go try to find yourself. So you go to Australia and you're not there. So you go to New Zealand, you're definitely not there. So you check out Paris and you're still not there. And you spend the year traveling around trying to find yourself. That's Cuppy. He just does it with stocks.
If you buy one share of each country, it's all a write-off.
There you go.
All right.
Well, thanks for joining us,
guys.
Cuppy. Take care.
Sure.
Thanks, Cuppy.
Bye-bye.
All right, cheers.
Cheers.
So, Patrick, it's my favorite time this week in trading history. I got to sit back and listen to you weave your tale of wisdom. What do you got for us?
Wisdom. Is that what that is?
Well, I guess so.
Anyway, we're going back to October 3rd, 2008. When George W. Bush signed into law the Troubled Asset Relief Program, also known as TARP, as a part of that Emergency Economic Stabilization Act of 2008. So let's talk about this. So TARP was created and run by the U.S. Treasury to stabilize the country's financial system and mitigate foreclosures in the wake of that 2008 great financial crisis. And in a nutshell, the Treasury sought to buy all the toxic assets and equities foolishly held by some of America's biggest financial firms. This program was signed into law by George W. Bush on this very week on October 3rd of 2008. as a part of the Emergency Economic Stabilization Act, which lasted for 2 years, ending October of 2010. Now, before we go on, we should note that the money TARP lent was eventually paid back to the government, and they actually turned a profit. But let's talk about the story and what it meant. And so it was September 2008. Global credit markets came to a near standstill. The monstrous, too big to fail American financial institutions like Fannie Mae and Freddie Mac, AIG, were edging closer to the abyss. The investment companies like Goldman Sachs and Morgan Stanley were even changed their charters to become commercial banks to weather the storm. In an attempt to stop the bleeding, the Treasury Secretary Henry Paulson pioneered the Troubled Asset Relief Program known as TARP. And so TARP's original purpose was to increase the liquidity of the money markets and secondary mortgage markets by purchasing the mortgage-backed securities, and through that reduce the potential losses of all the direct and indirect institutions that owned them. But the Treasury was allowed to purchase up to $700 billion, although that amount was amended to about $425 billion in the end. Essentially, the Treasury would buy up illiquid, difficult-to-value assets on the secondary markets, that is the trader over-the-counter markets, and thus allowing participating institutions to stabilize their balance sheets and avoid further losses. And so I figured that we simplify this to a simple analogy of, remember when you were a kid, Kev, and you thought you could make a killing starting up that lemonade stand? Well, 5 hours later, you're getting a sunburn on your lawn beside a table full of hot lemonade that is absolutely no one is buying. So your mom is watching you out the window, and she feels really bad for you. So she comes out and buys 1 cup of that tepid, fly-covered lemonade for $10, and then says, "Wow, this hot, stinky lemonade is one of the is just fantastic. I'll buy it all." So that's a good way of summarizing TARP. Did your mom enjoy that lemonade, by the way?
You know what? I'm a Canadian, so I was selling beer.
So here's how
and my mom drank it all, and she loved it.
So let's talk about how it broke down. So the government bought 125 billion of preferred stock. Obviously, preferred stock being higher up on the capital structure than the common stock of the 8 big banks. For this help, the banks were required to give the government a 5% dividend that would increase to 9% in 2013, encouraging the banks to buy back those preferreds within 5 years. The government then spent $182 billion on AIG, which gave AIG the money to pay the credit default swaps and avoid bankruptcy. For the credit and housing, the Fed created a $20 billion term asset-backed security loan facility known as TALF, and loaned that money to their member banks who could give the credit to homeowners and businesses. They also provided $45 billion for homeowner foreclosure assistance, although only around $5 billion was used. The reason banks didn't touch the other $40 billion, you might ask? Well, they cherry-picked applicants and refused to help those that had lower to no equity. Now, of course, the hypocrisy is that these were the same banks who just a few years before were giving out ninja loans to anyone because they were making big money hand over fist with every new mortgage. So finally, the government bought $22 billion of toxic mortgage-related securities that were essentially a write-off. It should be noted that TARP demanded that the companies involved lose their tax benefits and place caps on executive compensation and forbade bonuses. Even so, by 2009, bailed out firms paid some $20 billion to keep personnel, sardonically referred to as the TARP bonuses. So what's the TARP legacy? TARP recovered funds of $441 billion from the $426 billion they invested, actually earning like a $15 billion profit, while also saving the American auto industry. They stabilized the markets, and critics of TARP say that it rewarded bad behavior, sending a message to act irresponsibly and that they would be there to help out. But bankers still say the same thing now as they did back then. All hail the Fed put.
Nice. I like that.
Yeah, I mean, you were around back then. Same with me. That was quite the crazy time, wasn't it?
It really was. And you know what's strange, Patrick, is that after the .com bubble, I thought to myself, "Oh, it's never going to get worse than this. This is like when it burst. I thought that's the craziest it's ever been." Then we had 2008, and I thought to myself, "Oh, that's madness. We're never going to get a decline like that." And then we get the vid of 2020, and it's just like, just as we've talked about it before.
No, it was the most rapid drop of the COVID. But the thing is that the other two were much deeper, right? They cut much deeper, longer. I mean, there were companies that were down 90% off their highs when everything was said and done. And so the COVID was a nasty one, but it was over pretty quick. And we'll see whether it's over, actually. I don't even know.
That's true. You're right. Well, that's right, Patrick. Don't forget, we're still in a bear market, according to you.
Yeah.
But I agree with you that the 2008 / 7 and 8, it kind of lured you into thinking it was over, and then it just kept getting worse. You're absolutely right. Anyways, that's great. Thanks for sharing that with us today, Patrick.
All right. Well, it's time for the WTF clip of the week, and it's time to invite Taylor on. Taylor, how you doing, buddy?
Oh, I am just living the dream here. I'm drinking my my beer in my converted church Airbnb, just working remote. It's the best, my man.
So, yeah, you're not drinking our Oatmeal Brown Ale. You said you ain't doing that shit. So, what are you drinking?
I'm drinking that Hawaiian Punch beer I think you guys had a while ago, and I'm drinking it pinky up because I'm just a fancy guy.
There you go. All right, buddy. What do you have in store for us?
So this week in WTF, right, there's two things I love. I love Elon Musk, and I love the movie Super Troopers. Like, Favre is the best. It's hilarious. And when Battery Day was going down, there was all this hype, and everyone was pumping it everywhere. And then you knew it was going to be a sell on the day of. But anyway, I'm really proud of this mashup. I've been hearing some rumors that it's maybe one of the best, but I don't know. That's just what the word on the street is. I don't listen to that stuff. I just focus on what I do best, which is losing money in natural gas. So hit it, guys.
So you think it's an inherently risky move, that is the battery plans, with steep execution and operational challenges. Give me some sense as to what you're talking about there when you reference those challenges.
Reduce sales internally and basically bring in the battery supply chain internally. It's a lot of risk.
Emmanuel, you have a different view. I'm curious if you want to sort of rebut some of those concerns.
Yeah, we're about to get shut down anyway. I'd buy a $10 million car.
I know you're a believer in a broader sense.
Now, don't give me any lip.
In a broader sense, you are. But, you know, a $382 billion market value at the beginning of trading today. And clearly the market believes that if you want to really try and say that there's any reflection of actual fundamental value over time here.
Well, if you did, I'd activate my car's wings and fly away.
Well, I don't know if it's your best, but it was definitely good here, buddy. That's you know what? That's a classic movie.
Oh, it is. Oh, so I haven't seen the second one because I don't want to, I don't want to be disappointed. I just don't want to watch it. Like, I started watching Dumb and Dumber 2, and I was like, whew, okay, and I turned it right off because, wow, I don't want to
step away from the TV. Step away from the TV.
Yeah, definitely.
But listen, before we go on, I got to know what's going on with Nat Gas. How are you losing money on Nat Gas?
Here's the thing, right?
Welcome to the club.
I did a great tweet. You know, I did this. I was doing my little analysis, and it's right up against a trend line. It looks like it's going to pop, and I was like, everything in my body wants to go long on this thing. I was like, I'm going to go short in a big way. Go short, boom, pops down. And I was like, yeah, in the money. I'm like, you know what? I'm so good at this. I'm going to do it right at the fib, and I'm going to ride that bounce back up. And it just bounces back up, eats me down. And I'm like, I'm out. I was like, you know what? I'm going to get back in. Beats me again. And I'm like, I'm so done with this. It reminds me of trading Bitcoin. You just, they're so filthy. They know it. They read you.
The real problem was that you had the right instincts at first when you went against every instinct that you had in your body. Much like George Costanza did. I'm a bald, middle-aged man living with my parents. You want to go out for a date. And when you do that and you do the bizarro world, everything's fine. But then when you start to think you know something, that's when you're in trouble.
Anyways, I'll take that, and I'll report back next week on how I do. And if I make some profit, I'll split it with you.
Okay, sounds good. Thanks. Take care.
Okay, it's time to move on, Kev. But we're going to invite Lena on for the no stupid questions, and let's see what questions our listeners have for us this week, Kev.
I don't even know if I can read the questions properly. This beer went straight to my head, actually.
God, you finished it?
Well, almost.
You must like it because I'm sipping mine like it's warm.
I'm on the third
boxed
can.
wine.
I don't know about you. But...
We'll get to beers at the end of the show.
Okay, so tell us what we got here.
Yeah, so the first listener, selling an in-the-money call is a better hedge than buying an out-of-the-money put. Is this true, and why or why not? I know there are many variables that influence option prices, so it may be situational dependent, but could you comment?
Patrick, I'll let you do this one just since you're the option expert.
All right, well, let's start off by just saying that they're two very different trades. One of them, you're actually long gamma, and the other, you're short gamma. And so a lot of people will say, well, listen, why wouldn't you just hedge the downside risk by selling an in-the-money call? You extract this intrinsic value, and if the stock does decline, you didn't have to pay. You actually got paid for selling this call and collecting that premium. The problem is you have absolutely no upside, and you have all the left tail downside risk of the security. And so you are, in some way, I would always say, like, well, if you're going to sell a deep in the money call as a hedge, why don't you just even sell the stock? It's like, what's the point of being in it if you don't have the potential of making upside potential on the stock? One situation where it did make sense to do that was, I remember my boss back in the day had a huge whack of bank stocks that he got when he joined the company, and he had a zero cost base on it. So there was a massive tax consequence to selling this huge line of stock, and at the same time didn't want to spend the big money buying the puts. And so the selling the deep in the money was a way for him to hedge out downside risk on something that had a huge tax consequence to unloading. And I mean, unless there's a tax consideration or something like that, it's not a very good strategy in my mind. At least with a protective put, while it costs you money, if you're right about the stock direction, you still have all of the upside of the stock, right? Do you have some? Am I missing something, Kev? What's your take on
I'll
that?
just kind of briefly sum it up it this way. When you sell the call, your loss is unlimited. And when you buy the put, your loss is limited to the premium you paid. So they are two distinctly different strategies. And one of them is earning the premium by taking that risk of the unlimited loss. And the other one is basically paying for someone else to take that risk.
Yeah, so you're taking it. You're looking at it from that risk perspective, but it's also, you have to note that with the protective put, you have all of the upside of the stock, and with the short call, you have none of the upside, right? And they're completely different ways of hedging. And you're the scenario you're looking for. It's like there is always a right time and a wrong time for each strategy, but you just have to understand that they're not the same thing from a hedging perspective.
Anyway, next question.
Next question is, what is the average number of trades you have on at any given time? And do you have a limit on the size for each of the trades? 5 to 10%?
All right, you want to start, Kev?
Yeah. Why don't you start? I think yours will be a more traditional answer.
Well, sure. I mean, for me, I actually, let's start with sizing. I actually don't size my trades by percentage of portfolio, but by the size of the risk. And so I risk adjust each trade. And because I use a lot of options in my strategies, I usually am able to define my risk down to a very specific number of what the absolute worst case scenario is. And so my trade sizing varies but my risk is actually very consistent. And I usually am risking 1 to 2% of my portfolio in any one trade, and I have no fear of leveraging up and having positions that have a lot more leverage in the value of my portfolio, long as I can understand what the risk of each trade is, and that's the way that I approach it.
So Patrick is bang on correct, and the way I'll explain it is to say, if you think about the volatility of different positions, you might have, let's say, a euro-dollar futures contract that has a notional that is quite high when you look at the amount that you're trading in terms of notional amount, but in terms of the actual risk is quite low. So I might have a euro-dollar spread position that's 200, 300, 400% of my portfolio, which sounds like insane until you realize that the amount that's going to move around is a lot less than someone who might be short 10% of their portfolio in Tesla. Mm-hmm. And so that is the first thing to kind of understand, is that you can't look at it as notional. You have to look at it as risk, or at least that's how I do it. And then the second thing is, as someone who does it for a living and does it full time, I'm probably different in that I will probably be more willing to go concentrated at specific times than most. And if I was running money professionally, like meaning if I was managing money on people's behalfs, then I would obviously have to not I'd be more prudent. But as an individual, or as basically someone who trades for sophisticated investors, we can be much more kind of concentrated. So I will have things that are much higher than 10% of the portfolio, and but that's not for everyone.
Right.
So one of the good things to think about is, if you're going to lose, you make sure you don't have a loss that puts you out of the game, and that's the most important thing to realize. Patrick and I have talked about this numerous times, but you're going to end up having some bad trades. And if you have a string of them, you want to make sure that you're not having a string of them that is causing you a loss, whereas that you will be out of the game and not be able to trade anymore.
Exactly.
Anyways, hope that answers the questions.
All right, Lena, is there anything else?
Oh, I believe there was an additional question from this listener asking for, what is the favorite province to travel in Canada for you guys?
You want to go first?
No, you go first again. I got to think about it. I wasn't ready for this one.
You know what? For me, I would generalize it that you got to go either east or west. The coasts on either part of Canada are absolutely beautiful. And the more you move into the center of Canada, the shittier it gets. And so, long as you choose east or west,
hitting a low in Manitoba, is that what you're trying to say, Patrick?
There's that joke that is basically, why do the trees lean in Canada? Because Manitoba sucks.
Oh, no.
He's told that joke twice now, maybe 3 times.
But it's so appropriate right now. But you set me up for it. I would not have gone there. I would not have.
Okay, so listen, you got to pick a province. Go. Which one is it?
I'll have to go with BC.
BC is a beautiful, province. I actually like the interior just as much as I like the coastal. And I agree with Patrick that you probably end up having to do the coast. They're much more pretty and stuff. If I have to pick a province on the East Coast, I am going to go... I'll have to go Nova Scotia. I was going to go PEI, but PEI, I love the beaches, but after a while, the beaches kind of, they all seem the same. Nova Scotia has a little more variety. So I'm going Nova Scotia.
All right, there you go. All right. And Lena, if they have any questions, where do they submit it?
Listeners can submit their questions to nostupidquestions@markethuddle.com.
Perfect.
Thanks, Lena.
All right. Kev, it's time.
It's time. Okay, skin in the game. Let me give the rules, and this time I'll read the rules properly since we've had some incidents around this. Skin in the Game is a weekly opportunity for us, Patrick and I, to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows. A Duke and Duke, which is a $1 American dollar. Patrick likes to tell me all the time. A $1 bet. Then it goes up to a pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4 here in Canada, a bottle of wine with a $100 limit, no box wine for Patrick, and finally a steak dinner. Okay, so the winner of the bet is obliged to create a new bet for the following week. Now, this is where we fell down because we were using the loser. It's the winner that has to make the new bet, and we're going to do this properly from now on. The other important thing is all wagers settle in full, and there will be no netting of positions.
No netting of positions, physical delivery, like in the futures market.
Yeah, this is like before they cleared swaps, and there was no netting of positions, which caused basically the great financial crisis because there was no netting of positions. Well, we're going to create the great the great booze crisis of the Market Huddle by making no netting of positions. So that means if we win 4 pitchers of beer, there needs to be payment of 4 pitchers of beer. So if it's like 4-3, that means 7 will be drunk total. Okay.
Oh my God.
We have to
start banging these off, right? Because otherwise it's going to build up too big.
Yeah.
Anyway.
Okay. So let's talk about our bet last week. Oh, you go ahead, Patrick.
Well, no, I'm too embarrassed.
Yes.
You were so sure that I was winning.
No.
I knew. Then you looked. Then you looked.
No. So I thought I was looking good till this morning with the vid, with the Trump having the vid, and I thought, I'm going to lose because the market's blowing out. And the bet was as follows. I'll read it for those that aren't watching it on the YouTube. Will the OAS option adjusted spread, U.S. high yield broad credit spread, be higher or lower than plus 547 basis points on Friday? Okay, so Patrick gave me that, and obviously I chose tighter because Patrick's always trying to get me to be bearish, and I'm like, no, I'm going to be bullish. So I chose tighter, and it was looking good all week. And then I thought today it would blow out, and sure enough, nope, I'm good. So that's
536 basis points.
So
you clipped 11 points. You snuck it in there.
This is a hat trick for you.
Hat trick for
God.
me. So I did have one of our listeners notice that there's no such thing as triple tops. So I'm probably going to lose this one.
Well, you just had 3 wins.
Yeah. Oh, yeah, but maybe. Oh, that's right. So maybe I'm destined to win 4. I don't know. I don't know how I'm going to work that. There's no such thing as triple tops into this. But let me give you my bet. Okay.
All right.
So for those who don't know, Patrick doesn't know it. I made it up on the spot. I'll tell you the truth. I was doing it while he was doing his market history because I got bored during that section. So we're going to talk about the December contract of the copper future. So pull up a chart.
Yeah, I'm doing that right now.
I have
December.
December, Christmas. That's how when you're a real futures guy, you say Christmas copper.
All right.
Okay.
Christmas copper, 298.
298. Okay. So here's what I'm going to, and it has to settle by next week. I'm going to make ours a little more exciting. It's going to be a one touch. And for those who I present the trade, and then Patrick gets to pick what side he's going to be on. Okay. So it's whether the December contract next week will hit and touch 309.10.
So you saying touch up here to 309.10.
So you can choose yes, it'll touch that, or no, it won't.
It won't.
Oh, nice.
It won't. Right here. I drew the line right here. It won't.
Okay. Well, that was easy. Okay, now we got to do our bet. Pull up the starts as a Duke and Duke. So now it's my turn to. I'm going right to a pint of beer.
I'll do the burger.
You're going the beer. I'm going a pitcher.
Let's leave it at a pitcher.
Aren't we always doing pitchers though? Come on.
No, I'm not ready for a 2-4 yet.
He's feeling a little gun shy because there's been a lot of settlements the other way.
Wait a second. So wait. Pitcher, we're just going up to a 2-4. What kind of a 2-4 are we doing? Are we doing like the tall cans of the premium shit? Like, are we talking a $70 case?
No.
Or am I delivering you some Molson Canadian?
Yeah, you can deliver Molson Canadian.
Well, you get to pick though, don't you?
Well, I don't know. We haven't said the rules yet. Lena, get on. What do you think?
We should also include the keg in here. We haven't.
Oh no, I don't.
That's a lot of beer to drink, Lena.
That's a lot of beer. Yeah.
I think it should be tall boys.
Tall boy.
Lena's called it. Tall boys.
Forget it. I'm in. Forget. Let's take it to a case of beer.
Okay, we're done. Case of beer. Oh,
December contract, hitting that 303 spot 0910.
So if it hits 910, I get my case of beer.
Okay.
Sounds good. You're on. This is a good one.
All right. I hope you feel good about this.
Why?
Wait, do you have to drink the whole case of beer in one
No,
sitting?
No. We're gonna have a party.
This is.
All right.
I don't have to share if I win. If he gives me the case of beer, I can share with whoever I want.
Okay.
The pitcher has to. No, anyway. All right, listen. It was a good bet. Let's see what happens. I like it. All right.
Okay, thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow at the Market Huddle on Twitter. We're there every day. Lena's in charge. Give her a shout out. She gets tired of talking to Patrick and I. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate us on iTunes. I know it's a dumb game, but it makes a difference to Apple's algorithms, and it helps us out immensely. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can find me on my website, bigpicturetrading.com. Kev, where can they find you?
On Twitter, it's at Kevin Muir, M-U-I-R, or you can go check out my newsletter at themacrotourist.substack.com. And listen, we can never have too many friends, a bear market, bull market. We're just happy to spend time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right. Another show in the bag. That was a little longer than... We kept that a little tighter, didn't we, Lena?
Yeah.
Yeah, that was actually pretty tight.
Lena,
I'm
did you
actually
really
impressed.
drink your beer?
Yes, I did. I wasn't even kidding when I said I don't even know if I can read it properly. I was like, oh, wait a minute, I'm feeling pretty lightheaded.
This gets a new record for the least amount I've drank, and I'm just gonna say it. It's undrinkable.
What?
Yeah, you like it?
I'm on my third can. No.
If it's got alcohol in it, Patrick
Yeah.
will drink it.
I don't know. I must not like the brown ale.
No.
It's a heavier beer.
Yeah, but it's not the heaviness.
Stronger
It's just
tasting beer.
bitter, and it's just like,
Oh, my God.
I don't know.
It almost tasted like I was drinking coffee and beer at
Exactly.
the same time. Like almost like
Yeah.
a lighter Guinness, maybe.
A lighter.
Like that sort of
Lighter Guinness. I can drink all the Guinness in the world, and I can't drink one of these. Okay, I'm going to just get it out of the way. Quit talking before we lose more beer people. But 4-3 for my...
Oh,
Ooh.
that's a record low, I think.
No, it's not. He's gone lower. He has.
Patrick, what do you think about the beer?
You know what? I wouldn't. This is not my style of beer, but I was enjoying it. I'm not gonna shit on it like he is, but I'm not gonna give it a great score either. Either the 7-1. 7-1.
Okay.
I think that the oxygen from Patrick's mask is not getting to his brain or something. Got his mask on too tight or something. I don't know what's going on. Okay, Lena, what do you got?
I didn't hate it. I mean, obviously, I finished it. I kind of chugged it, I think. I would give it a 7.6.
Nice.
I'll be kind to you.
Nice.
Yours is...
Nice. No. See, you were shitting all over me, but you're being nice to her, which is
course.
just demonstrating to everybody that you're just biased. It's
yeah.
Or maybe I'm trying to avoid my career risk here.
Yeah.
Siding with my
Boss.
boss over here.
That's true.
You know?
And Taylor, your Hawaiian punch or whatever you're drinking.
My Hawaiian punch. Yeah, it's just gonna sound gross, but it tastes creamy.
Oh,
It's
God, it does.
Strange.
You
It's
should stop.
strange.
It's
Yeah.
Hawaiian punch, but it tastes creamy.
And you know
it
what?
was actually good.
They don't go.
Taylor's doing this from a church, and it sounds like God's talking to us, telling us his beer is creamy.
No, it's coming to me. He gave me some. Oh, he says go long that gas. Okay, great, good. Hopefully this is a tip I can use. No, it's great here, and it's creamy beers. So I give it a 6.
There it is. Another rookie score.
All right.
They're still learning about scoring.
There you go. Oh,
But can we talk about what we watched this week? I know what I watched this week, and I'm dying to talk
Okay,
about
so go ahead, Lena.
So I think I mentioned last week, and this is the reason why we didn't have a WTF clip last week, was because I was moving last weekend. And we're still in process of unpacking, but we decided to install the TV right away because I did not want to miss the debate.
Okay.
The U.S. election debate.
What
And
debate?
I had to What debate? I had to turn it off halfway through because I could not listen to it anymore. It was so cringeworthy. I don't know what you guys thought. I don't know if you guys watched it.
Oh, Lena, you're going to get us in trouble. We're not.
No, I mean, I'm not asking you to side with anyone. I just think the whole debate process was just really messy.
I actually didn't watch it, and I'm not being sarcastic. I think I was writing one of my macro tourist piece. And it wasn't even about the debate. I don't know. Patrick, did you watch it?
I didn't watch it in its entirety, but I did watch it. It was just a gloves off. You know, I'm actually looking forward to the vice president debate.
I don't know if they're going to have them.
No,
Do they do that?
Taylor, yes, they do.
I thought they were. I'm far more interested in listening to them two go at it. I think
Them
that
two.
it'll be no, but I think it will be far more an intellectual debate. I personally think if you anyway, I personally
I don't know how
I'm trying not to dig myself into any hole, so I'm not going to comment on it. But I think what I'll tell you is I actually was not surprised. Everyone came out was like I had friends that were telling me, "Oh my God, did you see her? And can you believe he said that?" I'm like, "No, actually, no. This is exactly what I was expecting to happen." It was so predictable that it was just going to be a shit show. Everyone knew it was going to be a shit show, and then everyone's surprised it was a shit show.
Yeah. I'm going to change the topic so we don't get into any trouble with
Yeah, agreed. Go for it.
I'm going to, I'm watching something new. One of my buddies recommended it. I had tried it, and the first episode was so bad I gave up on it. And then he kept raving about it, and I was like, I got to hang in there, I guess. And I have now become a fan. It's Ken Lasso. Do you guys know this?
Nope.
Oh, my God.
No. Is that like a radio personality turned into a TV show?
No, it's this. It's on Google. It's on Apple TV. Okay, and let me just look. What's I can't remember. It's this Michael. I don't know what his name is here. Wait, it's not Ken. It's Ted. I'm a complete knob.
Ted Lasso?
Yeah, sorry. So, Jason Sudeikis is the main guy, and it's about a football coach that goes to England.
Oh, I heard about this.
Yeah.
I heard about this.
And it's actually, if you're going to give it a whirl, give it more than one episode. That's my recommendation. Because the first episode,
I like Sudeikis,
the first episode wasn't very good, but it got better as it went along. And I've actually hit the point. And not only that, the interesting thing about it is they don't release it all at once. I don't know. This is Apple. They want to do it like regular TV. So I just got notification while we were doing this that the new Ted Lasso is on my TV.
But now, if the new
I'm going to be
episode
leaving you
comes out,
shortly.
but if the new episode comes out, you can still they keep all of the past episodes there, so someone can still go binge watch.
Yeah,
catch
that's right.
up, right?
Yeah.
Okay.
But anyways, it's pretty funny. It's good.
It's funny that I don't even know that.
Well, I understand. Patrick, you haven't turned on TV, and we should ask
No.
Patrick. Did you watch anything?
No,
else?
I have not. No, sorry.
What did you?
I
did you-
watched the debate. That's about it.
Really?
Yeah,
You didn't even finish watching
I
it
didn't
either.
even
So
do that.
what did you
My
do?
attention span is that low.
Okay, so I will give you my other piece of news. So remember this summer when I broke my hand mountain biking?
Yes.
Yes.
And my son and I have been going back to that hill and getting the courage to get up and try it again and do it. Actually, there's a bigger hill than the one I broke my hand on. I broke my hand on like the little baby one. But anyways,
You don't admit that. You don't admit that on there.
Does your wife listen to this podcast?
no, not a chance.
You broke your hand on the small hill, and then you're going to go back to the bigger hill.
That's right.
Dude, okay.
We
Okay, go on.
have now mastered it. We don't even hesitate. We just fly over this bad boy, and we're both so proud of ourselves. I know.
Can we get a video for
No,
next
it's
week?
embarrassing because it's not that big a deal. Like true mountain bikers would go, "You guys are wimps. I can't believe you broke your hand on that." But for me, it was pretty scary, and I'm now just flying over it. It's really good. I'm getting in shape. I'm feeling good.
Oh, yeah, it's great.
That's
You're getting in
awesome.
shape during COVID. That's a milestone. That's good.
Yeah.
Good for you.
It's and he's 15, so I suck a lot of wind trying to keep up with him at certain points. But You know, it's funny because he's not quite as strong, so sometimes on the big uphills, like he gets into trouble, and I can power through some things, but on the whole, usually I'm. And then he's kind of dumb on the downhill parts. There's like really long downhills, and I'm not quite as brave as him or stupid, and he goes faster than me, so we can't tell my wife about that part. But anyway, otherwise, it's correct.
Young and invincible. And invincible.
Well, we
right?
should touch wood. Anyway, so that's my big excitement. Nothing else really exciting happened.
All right.
How about you, Taylor? How long are you in the church?
You know, I'm in here for the next month, and let me tell you, I really respect you guys, and I really like you guys, and I'm sitting here, and every I have these little jokes that I want to throw in, but I'm like, I can't, man. I love these guys too much. They're too smart. What do I know? You know, I haven't made money in any of these natural gas. I don't want to touch on natural gas again, but I just really respect you guys. You know what? Oh my gosh, this is the beer talking. This is totally the beer talking.
I love you guys.
I've been watching.
I love
You know, during this week in trading history, Taylor messaged me and was like, "Is it just me, or is Patrick actually speaking really clearly this time?" And I said, I was just gonna say the same thing. I think he's just a little drunk.
He's a little drunk.
And just a little drunk.
Oh, Patrick's getting better at it.
I mean,
Yeah, it's like when you're.
Thanks,
you
guys.
can actually hold your.
Guys, thanks.
You can hold your breath a lot longer when you're drunk. Have you ever gone swimming drunk? You're like, I can hold my breath forever down here. That's what I found anyway. I've been watching a lot of 30 Rock this week, but which is great. Smart show, love it, hilarious, show businessy because my wife's in showbiz. But I've been waiting to watch The Servant on Apple TV, but we don't have Apple TV. But now we do because we're at an Airbnb. The Servant on Apple TV, which is like a horror TV show. I've been hearing.
who's in it?
Ugh.
Oh, I didn't know about this.
Nobody I would know.
Lauren Ambrose. No, so nobody. It's M. Night Shyamalan. Yeah. So pretty exciting.
Well, I don't know this.
Okay, well, I haven't seen it, so I'm just bringing it up in case you guys know more than me.
Ron Weasley's in it. Gotta watch it now. Ron Weasley's in it.
Ron Weasley's in it. You gotta watch it.
That's funny.
There's no
I'd
magic.
actually like to be
known.
known as forever as Ron Weasley. I know he probably made enough that it's probably worth it. I'll be known as Ron Weasley.
Yeah, he's laughing now, I'm sure.
Yeah. It's pretty awesome, actually, being known as Ron.
Yeah.
You know, what's the other guy? Harry Potter. He must go around everywhere, and like he's just always known as Harry Potter. It's like James Bond.
Actually, he tried to claim it back because he did live theater in England where he got naked on stage.
Yeah, I saw
think
that.
that's what his. Oh, you saw it? You went and
right.
saw it?
No,
Oh,
I
that's
didn't.
Interesting. No, I'm not really interested in that, but that's great. Good for you, Kev. I'm glad.
Okay, we went
No, I
there.
have no problem.
Great.
I have no problem.
Great.
It's Patrick that usually has the problems with those jokes.
That's true.
It's true. I have no problems with my jokes. It was
Your jokes are so great. I love my own jokes.
oh, well, anyways. Okay, so next week, 100. We got to think up something good to do.
Yeah.
That's right.
Yeah.
Stay tuned, everybody.
Guys, I've already got
Episode
something in the
100.
works. It's gonna be good. The 100, I'm really coming all out.
Oh, you
guns
have to do it.
blazing.
You have to do a great WTF.
Yeah.
Yeah.
Oh,
yeah.
Mm.
you want another video?
No
Yeah,
pressure.
I think another video might be appropriate.
Oh, okay. I'll do one this week. Okay.
Let's do it.
Okay, so
All right, let's tap out,
on that
boys.
note.
Well, before we go, I
ladies.
just want to know, Lena and Taylor, who do you think Patrick's going to win this week? I think he is, actually.
I am inclined to say
I think
yes.
he's going to win this week. I have this bad feeling about it.
Oh my God! Stop this. You know what? You're just.
No, you know why I have
it.
you know why I have a bad feeling? Because I bet bigger. I should have left it lower. I have a
You were
feeling.
cocky.
I have a feeling the gods are going to punish me for that.
I'm looking at it, and it's like the one touch. That's the key. Like just looking at it, the top of the wicks are just at 309.10, and I'm like, what does Kevin know that I don't? And I know it's most things, but it's like he might. I don't think so though. I don't even think it's going to get above 308.
Stop jinxing it, dude. Just stop.
Okay.
Don't say anything else. You are
Patrick
done.
really needs a win.
No more goochering the trades.
Yeah.
Everyone just stop talking about
You got
this.
George Costanza before he realized that he should be doing Bizarro World telling you that you're going to win, Patrick. I've never felt
Yeah.
better about a trade in my life, folks.
That's so crazy. I would say no. I'm on Patrick's side here, and I'm real sorry, Patrick.
nice.
But I'll buy you, or I'll eat some of those fries of the beer or the burger,
there you go.
whatever you guys bet on.
2-4.
I'm
I'll
there.
give you a can.
It's 2-4.
Okay.
Okay, well,
Well, that is. Thanks for tuning in. Check in next week for our 100th show. It should be a lot of fun. Thanks for sticking with us. Take care, everybody.
Take care, everyone.